Segment 1, Cold Open. The 15-all meal that enters a trillion-dollar machine. Last Tuesday, someone in Chicago ordered a burrito bowl on DoorDash, $15. Not exactly a financial event, but at checkout, the app offered a little nudge. Pay in 4, interest-free. She tapped it, and in that moment, without knowing it, she stopped being just a customer. She became raw material. That $15 IOU, along with millions of others just like it, was about to be pooled together with 100,000 similar promises, sliced into layers of risk, stamped with a credit rating, and sold to an institutional investor on the other side of the world, quite possibly sitting inside your retirement fund, under a line item you have never read. This process has a name. Wall Street calls it securitization, or more specifically, Asset-Backed Securities, ABS. And if that term sounds like something buried in a graduate-level textbook, consider this: the U.S. ABS market alone is worth over $880 billion as of late 2025, according to Bank of America data tracked by Janus Henderson. Globally, the number crosses $2 trillion. Every time you swipe a credit card, sign an auto loan, or tap Pay Later on a $40 Amazon order, you are feeding a machine that most people never see and fewer understand. 91 million Americans have now used at least one Buy Now, Pay Later service. Nearly half of them missed a payment last year, and the vast majority of that debt is invisible. It does not appear on credit reports, it does not factor into credit scores, and no regulator is tracking it in real time. The Federal Reserve's official term for it is phantom debt. ABS was invented to solve a real problem: how to keep credit flowing without trapping lenders under mountains of illiquid debt. In its best form, it is one of the most elegant pieces of financial engineering ever designed. In its worst form, it nearly destroyed the global economy in 2008. And right now, in 2026, a version of that same machine is running at full speed, but with new fuel: Buy Now, Pay Later loans, subprime auto debt, and a shadow lending system that doesn't show up on any bank's balance sheet. Today, we are going to open the hood. We'll walk through exactly how the machine works, step by step, no jargon left unexplained. Then we'll look at what happened the last 2 times it broke, and then we'll ask the uncomfortable question: is it breaking again, right now, while Wall Street pops champagne over record bank earnings? Let's start with the engineering. Segment 2, the alchemy, how ABS actually works. Imagine you run a large consumer lending platform. Think Affirm, Klarna, or any major bank's credit card division. Every day, thousands of people borrow money through your app. Someone finances a laptop, another splits their groceries into 4 payments, a third takes out a personal loan to cover a dental bill. Each of those transactions creates a small IOU, a promise to pay you back, with interest, over time. Now, you could sit on those IOUs and wait for the money to trickle in month by month, but in a business that lives and dies by capital efficiency, that patience is a luxury you cannot afford. Your investors want growth. Your competitors are scaling faster, and the cash you lent out is trapped, frozen inside millions of tiny repayment schedules. So you do something clever. You take those IOUs, maybe 1 million of them, and bundle them together into a single pool. 100,000 laptop loans, 500,000 BNPL transactions, 300,000 credit card balances, all combined into one enormous basket of receivables. In the industry, this step is called pooling, and the resulting collection of debt is called the underlying asset, the foundation of everything that follows. But here is the first problem. If you, the lender, go bankrupt tomorrow, what happens to that pool? Creditors would swarm. Courts would freeze assets. The investors who bought into your debt pool would be left fighting for scraps in a bankruptcy proceeding. No sophisticated investor would accept that risk. So the financial world invented a structural solution of genuine elegance: the Special Purpose Vehicle, or SPV. You create a new legal entity, essentially a shell company with no employees, no operations, and no purpose other than to hold that pool of debt. You then sell the pool to the SPV. This transfer is legally irrevocable. From that moment on, even if your company collapses, the pool is untouchable. It sits inside the SPV, walled off from your corporate fate. This concept, bankruptcy remoteness, is the single most important structural feature of modern securitization. It is the firewall that makes the entire system possible. Now, the SPV holds, say, $10 billion worth of IOUs. It needs to convert them into something investors can actually buy. So it issues bonds, asset-backed securities, against the cash flows those IOUs will generate. But not all investors want the same thing. A pension fund managing retirement savings for school teachers needs near absolute safety. A hedge fund chasing alpha wants higher returns and will tolerate higher risk. A sovereign wealth fund wants something in between. To serve all of them from a single pool, the SPV slices the bonds into layers, a process called tranching. Picture a three-tier waterfall. At the top sits the senior tranche, typically around 70 to 80% of the total. These investors get paid first. Every dollar that flows in from borrower repayments hits the senior tranche before anyone else sees a cent. Because of this priority, the senior tranche carries the lowest risk and earns the lowest yield. Rating agencies often stamp it AAA. This is where pension funds, insurance companies, and sovereign wealth funds park their money. The middle layer is the mezzanine tranche, roughly 10 to 15%. These investors only get paid after the senior tranche is fully satisfied. More risk, more yield. This is typically where asset managers and family offices play. At the bottom sits the equity tranche, sometimes called the first loss piece, 5% or less. This layer absorbs every dollar of loss before anyone above it feels a thing. If borrowers start defaulting, the equity tranche takes the hit first. It gets wiped out before the mezzanine even begins to erode. But if borrowers pay on time, the equity tranche captures all the excess return after the senior and mezzanine investors have been paid their fixed coupons. Maximum risk, maximum upside. And here is a detail that matters enormously. In most ABS structures, the company that originated the loans, the one that created the pool in the first place, retains the equity tranche. This is called credit enhancement, and it serves as a signal to the market. The originator is saying, if losses hit, I eat them first. My money is on the line. This alignment of incentives is what gives institutional investors the confidence to buy in. The waterfall model is what makes ABS so powerful. A single pool of messy, heterogeneous consumer debt, credit cards, auto loans, BNPL transactions, gets sliced into products tailored to every risk appetite on the planet. It is, by any measure, brilliant financial architecture. But it has a weakness. And the weakness is not in the structure, it is in the incentives. Segment 3, the leverage loop. How 5 billion becomes 500 here is where the machine shifts from elegant to dangerous. Once you've sold your $10 billion pool to the SPV and the SPV has issued bonds to investors, you, the originator, get your cash back. Almost all of it. You retained the 5% equity tranche, so you spent $500 million of your own money. But the other $9.5 billion comes flooding back into your accounts as fresh capital. What do you do with that cash? The answer is obvious. You lend it out again. You issue new BNPL loans, new credit card balances, new personal loans. And once that new batch of IOUs accumulates to a sufficient size, you pool them again, create a new SPV, issue a new round of ABS, and sell them to a new set of investors. Let me walk you through the arithmetic, because the numbers are what make this extraordinary. You start with $1 billion of your own capital. You lend it out. You securitize the resulting receivables, keeping the 5% equity slice, $50 million. The other $950 million comes back as cash. You lend that out, securitize again, keep $47.5 million, recover $902 million, lend it out again. By the 10th cycle, your original billion has supported over $9 billion in cumulative lending. By the 20th cycle, you are approaching $17 billion. By the 40th, and we are about to see a real-world case where someone actually did this, your $1 billion has generated roughly $35 billion in outstanding consumer credit. You have just completed multiple cycles of what the industry calls revolving securitization. And here is the critical insight. At no point did you violate any individual regulatory limit. Each individual securitization was properly structured. Each SPV was legally independent. Each tranche was rated according to standard methodology. The danger is not in any single step, it is in the cumulative velocity of the loop. Each cycle, you retain only the equity slice, 5%. The other 95% comes back as deployable capital. If you run this loop 10 times, your original capital base has supported lending volumes 20 times its size. Run it 20 times, you are approaching 40-to-1 leverage. Run it 40 times, and this is not hypothetical as we will see shortly, you reach leverage ratios that would make a traditional bank's risk committee physically ill. The critical question becomes, what is the quality of the underlying asset? If the borrowers in your pool are creditworthy, employed, stable, making payments on time, the system works beautifully. The senior tranche stays safe. The mezzanine earns its premium. The equity tranche collects its excess spread. Everyone wins. But if the underlying borrowers start defaulting at higher than expected rates because of a recession, a job market shock, or because the lending standards were too loose to begin with, the waterfall runs dry from the bottom up. The equity tranche evaporates. The mezzanine starts taking losses. And if the default wave is large enough, even the AAA-rated senior tranche, the one your pension fund owns, begins to crack. This is not theory, it has happened, twice, and both times it reshaped the global financial order. Segment 4, The Inventor's Regret, the Crisis, and 100 Times Lever. In 1977, a college dropout working the mortgage trading desk at Salomon Brothers had an idea. His name was Louis Ranieri, and he realized that if you could take thousands of individual home mortgages, each one a 30-year commitment from a homeowner, and package them into a single tradable bond, you could unlock an entirely new asset class. Banks could offload mortgage risk, investors could access housing market returns without buying houses, and capital would flow more freely into homeownership. Ranieri did not just build the first mortgage-backed security, he coined the word securitization itself. By 1984, his mortgage desk was generating more profit than every other department at Salomon Brothers combined. But over the next 2 decades, Wall Street did what Wall Street does. It took a good idea and stretched it until it snapped. Mortgage-backed securities evolved into collateralized debt obligations, CDOs, which repackaged the riskier tranches of MBS into new structures. Then came CDO squareds, CDOs made from other CDOs, layer upon layer of abstraction, each one moving further from the actual homeowner making monthly payments on an actual house. By 2006, the quantitative models at the major banks had concluded, with the serene confidence of a spreadsheet, that nationwide home prices could not decline simultaneously. That assumption was embedded in every risk model, every rating, every tranche. When it turned out to be catastrophically wrong, the cascade was instantaneous. Equity tranches vaporized, mezzanine tranches followed, and then the unthinkable happened. AAA-rated senior tranches, the ones pension funds held, the ones that were supposed to be as safe as government bonds, defaulted. Lehman Brothers filed for bankruptcy. The global economy contracted by over $2 trillion. Millions of people lost their homes and their jobs in a single year. Louis Ranieri later described what happened to his invention as something that left a permanent scar, an innovation that, in his words, got abused beyond everybody's imagination. Now, you might think 2008 was a uniquely American catastrophe, driven by a uniquely American housing bubble. But the underlying mechanism, ABS leverage pushed to the point of systemic fragility, played out again, in a different country, with different underlying assets, just 12 years later. In China, a fintech company called Ant Group, the financial arm of Alibaba, had built the world's most sophisticated consumer credit scoring system, using e-commerce transaction data, repayment histories, and behavioral signals to issue unsecured microloans to hundreds of millions of users. The company registered 2 small loan subsidiaries with a combined capital base of roughly 30 billion yuan, about $4 billion. Under existing regulations, that capital could support maybe 3 times its value in outstanding loans. But Ant discovered the ABS lever. It pooled its microloan receivables, issued ABS, recovered the cash, and relent immediately, cycling the same capital through the securitization machine over and over. Industry reports and public statements from local officials confirmed the company ran this loop approximately 40 times, inflating its lending footprint from 30 billion to an estimated 2 trillion yuan, leverage approaching 100 to 1. In October 2020, the company's founder publicly called the Basel Banking Accords, the international framework designed specifically to prevent this kind of systemic risk, an old man's club. Within 2 weeks, Chinese regulators halted Ant's record-breaking IPO, capped ABS leverage at 4 times net assets, and mandated a 30% minimum contribution for co-lending arrangements. The restructuring took years. The point of this story is not that China uniquely mismanaged securitization. The point is that the ABS leverage loop creates the same incentive everywhere. Lend as much as possible, securitize as fast as possible, retain as little risk as possible. The machine does not care which country it runs in. It cares about volume. And right now in the United States, the machine is running on new fuel. Segment 5, new fuel. BNPL, subprime auto, and the art of pretending. If you've used Klarna, Affirm, Afterpay, or Apple Pay later in the past year, you've participated in the newest layer of the securitization machine. Buy now, pay later lending hit an estimated $560 billion globally in 2025. In the US alone, roughly 90 million people have used at least one BNPL service. Here is the part that should concern you. According to the Federal Reserve Bank of Richmond, most BNPL loans are not reported to traditional credit bureaus. The Fed's term for this is direct, phantom debt. It does not appear on a borrower's credit report. It does not factor into their credit score. It is invisible to any bank running a standard affordability check. A consumer could have 7 active BNPL commitments across 7 different apps and still look perfectly clean to a mortgage lender. LendingTree's 2026 report found that 47% of BNPL users made at least one late payment in the past year, up 13 percentage points from just 2 years prior, and more than half of BNPL users told surveyors they would not be able to make ends meet without these services. This is not discretionary spending on luxuries. People are splitting grocery bills and DoorDash orders into installments. They are using BNPL to pay rent. The product has migrated from convenience tool to survival mechanism, and most of this debt is being securitized. In 2025, unsecured consumer loan ABS issuance, which includes BNPL, hit a record high driven by fintech-originated lending and demand from private credit-aligned sponsors. But BNPL is only one tributary feeding the machine. The larger stream, and the one closer to breaking, is subprime auto lending. There are roughly $1.5 trillion in auto loans outstanding in the United States. About 15% of those were rated subprime at origination, borrowers with credit scores below 620. The 60-day-plus delinquency rate on subprime auto loans packaged into ABS hit 6.9% in January 2026, a 32-year record, according to Fitch Ratings. Behind that number is a practice that Wall Street insiders call extend and pretend. Here is how it works. A borrower calls their lender and says they cannot make the $500 monthly payment on their car. Under normal circumstances, the lender would repossess the vehicle and record a loss. But here is the problem. The car has depreciated so steeply, used vehicle values have been falling since the pandemic-era spike, that repossessing it would crystallize a loss far larger than continuing to pretend the loan is performing. A car the borrower owes $30,000 on might now be worth $20,000. The lender would eat a $10,000 loss the moment they take the keys back. So instead, the lender restructures the loan, extends the term from 3 years to 5 or from 5 to 7, reducing the monthly payment to $200, something the borrower can barely manage. The loan never technically defaults. The bank's balance sheet stays clean. Everyone exhales. This is how you end up with 100-month auto loans, over 8 years of payments on a vehicle that loses roughly 15% of its value every year. The car will be a rusting shell long before the loan is repaid. But the loan will never show up as delinquent in the bank's quarterly earnings because the terms were restructured before it could. Recovery rates on repossessed vehicles have already dropped substantially for both prime and subprime borrowers in recent years, according to industry data, which only increases the incentive to extend rather than repossess. The borrower is trapped in a depreciating asset with negative equity. They cannot sell the car without writing a check for the shortfall, and they certainly do not have that cash. The lender has a performing loan on paper that is functionally impaired, and the ABS investors who bought the bonds backed by these loans, they see a delinquency rate that looks manageable because the defaults have been cosmetically deferred, not eliminated. Segment 6, the Eisman question. Who is lying? If you have seen The Big Short, you remember the character Mark Baum, the abrasive, morally outraged fund manager who cannot believe how rotten the system has become. That character was based on a real person, Steve Eisman, a veteran Wall Street analyst who made billions betting against the subprime mortgage market in 2008. Eisman is the kind of investor who reads the footnotes of footnotes, the kind who will fly to Florida and personally interview a stripper with 5 investment properties just to confirm his thesis. He is, by temperament and training, a professional skeptic. Eisman has been looking at the numbers again, and what he sees, according to a detailed interview published earlier this year, is a contradiction so stark that it keeps him up at night. On one side of the ledger, the macroeconomic data looks robust. JP Morgan and Bank of America are reporting strong profits. Official default rates are flat, in some cases suspiciously flat. Loan loss provisions have barely moved. The headline consumer spending figures are holding up. Wall Street analysts, dressed in bespoke suits and speaking into Bloomberg terminals, assure everyone that the American consumer is resilient. Treasury Secretary Bessent has publicly declared the economy fundamentally sound. On the other side of the ledger, the University of Michigan Consumer Sentiment Index has sunk to levels not seen in decades. Real people, the ones buying groceries, paying car insurance, covering emergency repairs, are reporting a level of financial anxiety that directly contradicts the calm on Wall Street's balance sheets. Eisman's question is disarmingly simple. If consumers are really doing this well, why are they this miserable? One side is lying. Which one? A senior investigative analyst featured in the same interview offered a framework that cuts to the bone. Consider a typical American household earning $100,000 a year. The earner is employed. They got a modest raise. On paper, they are fine. But auto repair costs have risen 50% since the pandemic. Insurance premiums are up. Delivery fees, utility bills, co-pays, the unglamorous, unavoidable costs of daily life have all inflated significantly. These costs never appear in a Wall Street earnings presentation. They do not fit into the curated narrative of consumer strength, but they function like invisible grinders, methodically draining disposable income from the people who have the least margin for error. The analyst cited a metric that traditional banks use as a hard boundary: the debt-to-income ratio. Historically, anything below 30% was considered safe. You spend less than a third of your income servicing debt, and banks will lend to you without hesitation. But the analyst's field research suggests that for a growing segment of the middle class, that ratio has quietly climbed towards 60%. To put that in concrete terms, 60% means more than half of every paycheck goes directly to servicing existing debt, mortgages, auto loans, credit cards, student loans, before a single dollar is spent on food, fuel, or savings. At 60% DTI, traditional banks stop lending. The credit window slams shut, and when that happens, these borrowers do not disappear from the economy. They do not suddenly stop needing cars, groceries, or medical care. They simply migrate from the regulated banking system into the unregulated one. The answer is the shadow system. BNPL apps that do not check credit, private lenders operating outside the regulatory perimeter of the banking system, and increasingly, a category of capital that has grown explosively over the past 5 years with almost no public oversight: private credit. The analyst coined a term for what is happening, a play on recession that deliberately avoids the technical definition. He called it a vibecession. The data says there is no recession. The people living through it say there already is one. And the disconnect between the two is not a mystery, it is structural. What we are witnessing is a K-shaped recovery in its most advanced form. The upper arm of the K, households with equity portfolios, real estate, and stable six-figure incomes, are spending lavishly. Luxury goods, European vacations, home renovations. Their consumption is so enormous that it props up the aggregate spending figures like a thick layer of foundation over a cracked surface. From the macro data alone, the economy looks healthy. The lower arm of the K, households running on fumes, cycling debt across BNPL apps, trapped in negative equity auto loans, borrowing from next week's paycheck to survive this week, are experiencing a slow-motion financial collapse. But it is a collapse without a headline. No one is standing in breadlines. No bank has failed. The devastation is distributed across millions of individual balance sheets, too granular to trigger a systemic alarm, too widespread to ignore if you look at the right data. Wall Street's balance sheets are not technically lying. They are performing a perfectly legal magic trick, using extend and pretend off-balance sheet ABS and restructured loan terms to lock the rot inside the future, where it cannot be seen in this quarter's earnings report. The question is not whether the rot exists, it is how long the trick can hold. Segment 7, your retirement fund and the invisible beast. If the risk were confined to subprime borrowers and BNPL users, you might argue it was a contained problem. Painful for those involved, but not systemic. What makes the current situation structurally dangerous is where the money is coming from and how it got here. To understand the plumbing, you need to go back to 2020. When COVID hit, the U.S. government distributed trillions of dollars in stimulus payments. For a brief, artificial moment, borrowers who had spent years living paycheck to paycheck suddenly had cash. They paid off overdue bills, they cleared delinquent balances, and overnight their credit scores surged. Not because their underlying financial health had improved, but because the scoring models only look backward. The FICO system saw recent on-time payments and concluded these were creditworthy borrowers. Banks saw the inflated scores, opened the lending floodgates, and issued auto loans, credit cards, and personal credit lines to people whose fundamental ability to repay had not changed at all. The analyst in the Eisman interview described it bluntly. The definition of subprime itself got scrambled beyond recognition. Now the stimulus is gone. The inflated credit scores are deflating. But the loans issued during that window are still outstanding, many of them securitized, many of them sitting inside ABS structures, many of them rated investment grade based on default assumptions that were calibrated during an era of artificial creditworthiness. When traditional banks realized the true repayment capacity of these borrowers and began tightening standards, a massive pool of unmet demand opened up. Private credit, essentially lending by firms that are not regulated as banks, rushed in to fill the gap. Over the past 5 years, private credit has grown into a multi-trillion-dollar industry, funding everything from subprime auto loans to BNPL platforms to commercial real estate refinancings that traditional banks will not touch. The funding for private credit does not come from deposits. It comes from institutional investors, pension funds, insurance companies, endowments, and increasingly the target date retirement funds inside your 401(k) or equivalent retirement account. Here is the mechanism. You contribute to your retirement fund every month. You selected a target date fund, the kind that automatically adjusts its allocation as you approach retirement, shifting from equities to bonds and alternative investments as you age. You assumed those alternatives were conservative. Maybe some real estate exposure, maybe some infrastructure debt. But in the hunt for yield in a low-rate environment, many fund managers quietly allocated a portion of those alternatives to private credit. Your retirement savings, the money you are counting on to fund your life after you stop working, may be providing the capital that a private lender uses to issue a 7-year auto loan to a borrower with a DTI ratio of 60% on a vehicle that will be worth less than the outstanding loan balance within 18 months. You cannot verify this by reading your fund's prospectus. Private credit positions are typically reported as a single-line item, alternative fixed income or diversified credit, with no transparency into the underlying borrowers, their creditworthiness, or the delinquency status of the loans your money is funding. This is not speculation. A case earlier this year showed exactly how the chain can snap. A company called First Brands, a major auto parts manufacturer, defaulted on $2.3 billion in debt. The recovery rate for creditors? 0. Not 50 cents on the dollar. Not 10 cents. 0. The entire $2.3 billion was written off. The investors who funded that debt, many of them institutional, many of them managing other people's retirement savings, received nothing. In the parlance of structured finance, this is what happens when the equity tranche, the mezzanine tranche, and the senior tranche all get wiped out simultaneously. The waterfall ran completely dry. The phrase that best describes this arrangement is one that transcends language and political orientation. Privatize the profits, socialize the losses. When the loans perform, the originator and the fund manager collect fees and carry. When the loans fail, the losses land in the retirement accounts of people who never knew they were exposed. Private credit is sometimes described as a black box. That is too generous. A black box at least has a flight recorder. Private credit has almost no mandatory public disclosure of default rates, loss severity, or borrower concentration risk. You cannot audit what you cannot see, and as of early 2026, nearly $1 trillion in commercial real estate loans alone are scheduled to mature, forced refinancings that will test the solvency of lenders and borrowers across the entire chain. The analyst in the Eisman interview put it simply. When asked what kind of event would finally expose the hidden stress, he said, "The first sign will not be a bank failure. It will be a cliff in consumer spending data. The moment extend and pretend can no longer paper over the gap between what people earn and what they owe, the real economy will catch up with the balance sheets, and fast." Segment 8. Closing. The machine is not the villain, but you need to read the manual. Let me be clear about something. Asset-backed securities, as a financial technology, are not inherently destructive. The ability to transform illiquid receivables into tradable bonds genuinely increases capital efficiency. It allows lenders to serve more borrowers. It gives investors access to diversified consumer credit exposure. It keeps the gears of the credit economy turning. When ABS is properly structured, honestly rated, and adequately capitalized, it is one of the most useful inventions in the history of finance. The problem is never the machine itself. It is always the leverage ratio, the quality of the underlying asset, and the honesty of the people operating it. In 2008, the problem was mortgages issued to borrowers who could not repay them, packaged into securities rated AAA by agencies with catastrophic conflicts of interest, and leveraged to a level that left zero margin for error. The machine was fine. The inputs were poisoned. In 2020, the problem was consumer microloans cycled through the securitization loop 100 times. creating leverage that could absorb exactly zero macroeconomic shock. The machine was fine. The throttle was jammed open. And in 2026, the warning signs are familiar enough to recognize, even if the timeline remains uncertain. Subprime auto ABS delinquency at a 32-year high. BNPL debt growing 20% annually, invisible to credit bureaus, with nearly half of users reporting late payments. Private credit expanding into every crevice that regulated banking abandoned. With no public reporting, no standardized stress testing, and deep entanglement with retirement funds that ordinary savers cannot see through. I am not going to tell you a crisis is imminent. I am not going to tell you to sell anything or buy anything. That is not what this channel does. What I will give you is 3 numbers you can track yourself. Publicly available, updated regularly, and collectively more informative than any Wall Street earnings call. The first is the Fitch Subprime Auto ABS Delinquency Index. It is published monthly. It tells you in a single number whether the borrowers at the bottom of the auto lending pyramid are keeping up with their payments. When you see that number cross 7% on a sustained basis outside of seasonal patterns, pay attention. The second is the CFPB Buy Now Pay Later report. The Consumer Financial Protection Bureau has published increasingly detailed analyses of BNPL lending practices, default rates, and consumer behavior. The next report will tell you whether phantom debt is growing or stabilizing, and whether the 47% late payment rate is an outlier or a trend. The third is the Federal Reserve's monthly consumer credit release, specifically the breakdown between revolving credit, credit cards, and non-revolving credit, auto loans, student loans. When revolving credit growth decelerates sharply while non-revolving credit stays flat, it often signals that consumers have maxed out their flexible borrowing capacity and are relying on structured debt to stay afloat. That divergence preceded the 2008 crisis by roughly 14 months. The machine that turns your debt into someone else's investment is not going to stop running. It is too profitable, too embedded, and too useful in its legitimate form. But every previous crisis involving securitization followed the same pattern. The leverage climbed gradually, the underlying asset quality deteriorated quietly, the rating agencies adjusted slowly, and by the time the headlines caught up, the losses were already baked in. Understanding the machine will not protect you from every risk, but it will ensure that the next time someone offers you zero-interest installments on a $15 meal, you will know exactly what you are looking at. Not a gift, not a deal, but an invitation to become someone's underlying asset. Every financial crisis in the past 50 years has followed the same emotional arc. First, the machine works so well that everyone forgets it can break. Then, the leverage climbs so gradually that no single increment feels dangerous. Then, someone points out the cracks, and they are dismissed as a pessimist, a crank, a short seller with an agenda. And then the cracks widen until they cannot be dismissed, and by that time, the losses are already locked in. I do not know whether 2026 will be the year the current cycle breaks. No one does. Anyone who tells you otherwise is selling something. But I do know this. The machine is running. The leverage is real. The underlying asset quality is deteriorating by every measure that matters, and the people most exposed are the ones who know the least about how the system works. Now you know how it works. What you do with that knowledge is your decision. Thanks for watching. I'll see you in the next one.